And so we come back to, really, what is gold? Gold is the king of currencies.
It is, I picture it like a yardstick it's not made out of rubber, okay? If you had a rubber yardstick, you could stretch it when you needed to, what have you.
Yeah.
But gold is a solid yardstick, and to even call it a currency, it is a currency, which means we shouldn't call the fiat currency because it's really not, right?
Paper promises to pay.
But we've got thousands of years, right? We've got thousands of years of history. It's amazing how people still don't see it.
Yeah, since the Lydian Empire, gold has been sort of the enduring reference point. Gold demand in the present period, it tends to rise in value when devaluation concerns are increasing, when you have competitive devaluations between trade partners. And that is a real threat. That is a present tense real threat. Even though gold is no longer a part of our monetary system, it serves as a signal for growing concerns that bad money is proliferating, and it takes on the historical good money role.
Right. Well, and I'm so often asked right now, Dave, so are you, how long is this going to last? But what they're really asking is, how long is this price increase going to last? It's really, the question is a longer term question. How long will gold preserve wealth? That's really the question that should be answered. But the price is moving so rapidly right now. It's easy to lose that focus.
Yeah, well, capital is moving to safety. And precious metals cannot have the vast quantities of fiat currencies squeeze into them without a violent price adjustment higher. That's precisely what is happening. So how long does it continue? Well, the question is one of global dysfunction. It's one of policy dysfunction. I mean, it can be categorized in many ways. Monetary policy, fiscal policy, international relations, domestic political policy objectives. These are the things that define the dysfunction of the world we live in, and also are the catalyst for capital moving to safety.
Morgan was reporting on what was said at Davos last week about globalization, and it sounds, the way Morgan summarized it was, the gig is up. Okay, at this point, this dollar system, this Bretton Woods system that we've learned to live with since 1944, it's going to change.
Well, again, going back to Ray Dalio's comments at the WEF, he was chiding the audience. Stop talking about the end of the global order. It's not ending, it ended. and
it's
so
already happened.
It's already happened. Yeah. So, to some degree, we are seeing a version of a reset and a reorientation to real things. Mm-hmm. So, not only is gold shifting back towards its historic currency role, it's also being sought as an asset class that's less fragile in the context of bloated debt obligations. And, that's what we saw from Morgan Stanley's chief investment officer. When he's suggesting that you cut your bond position in half, that was the old anti-fragile asset. No, you should cut that in half and introduce 20% into your portfolio.
What a radical statement from Wall
20-20
Street.
instead of 60-40.
Yeah.
We have yet to see a gathering of investors seeking the safe haven qualities of gold from equity market volatility. Equity markets are pretty strong. I mean, not priced in gold, not priced in gold at all.
Right.
In fact, the Dow gold ratio is slipped to single digits.
Isn't that amazing?
Keep that in mind as you look at your portfolio and proudly squawk about S&P's returns, at NASDAQ's returns last year. In real money terms, you lost your shirt. So there will be successive waves of interest in the metals as new uncertainties emerge and as new headlines underscore the frailties already present within the financial system. It's hard to fathom that these are the early stages of a move in metals, particularly for someone who's owned it for a long time. And we have plenty of clients who are taking profits, and that's fine. But it's hard to fathom that these are early stages, but these are indeed the early stages of a broader adoption cycle of metals within the everyman's asset allocation.
So you say everyman, okay, and if you get into a group, okay, you and I are both members of groups outside of our little gold world here. And if you get in a crowd of people and just ask them, what do you think about gold? What do you think about the stock market? What do you think about $38 trillion in debt? What's your thought?
Yeah, I would ask those questions, if you're curious, how far along are we in the cycle?
Yeah.
Who do you know that even knows what fiat currencies are?
Yeah.
I mean, think about that.
Well, the people we work with
Well,
do.
sure, yeah.
But outside of this place, no.
It's a very small circle.
Yeah.
And so, for Ray Dalio, I mean, he runs the largest hedge fund in the world. Of course, hedge fund managers know the difference between fiat and a metal-backed currency.
Right.
They know the history of currencies. They know the history of the bond markets, the stock markets. Like, they make money with money because they have an edge, and the edge is informational. And this is information that we already have, but the vast majority of people are not even aware of what a fiat currency is. Who do you know that is cognizant of corporate debt and government debt being near or past capacity limits?
Right.
This just isn't what people do. People pick up the kids, they take them to dance, they do this, they run around and get ready for dinner. I mean, life is full of stuff that has nothing to do with what we do on a daily basis. Right. Who do you know that tracks the extreme overvaluation in equities, market cap to GDP, in excess of 226%?
Right.
Who do you know that acts in an anticipatory manner rather than reactively? Right? These are folks who will buy gold at some price, probably between here and $10,000 an ounce, and it's going to be a reaction to something. They were not anticipating anything because they were just going about their lives as if everything was fine. And as long as they get a statement and they've made progress, if it's 5% or 15%, whatever the percentage gain is, they're happy.
Yeah, but these are the same people, Dave, that if you say, do you have a 401k? They'll say, oh, yeah.
Yeah.
What's in it?
I don't know.
I don't know, but I'm going to retire in 2032. And
I've got a target date fund.
Yeah,
it's perfectly matched, and it's going to perform. I'll be able to retire in 2030, whatever it is.
So let's be clear, though, Dave. You're not
saying...
But
I mean, another question. Who do you know that has already hit the Morgan Stanley CIO's recommendation of a 20% allocation to gold? Who in your world has 20% of their assets in gold already?
Well, okay, so pretend like you're in a cocktail party with a bunch of stockbrokers from Morgan Stanley. How many of those guys have 20% of their portfolio or their client's portfolio?
1 in 100, maybe 1 in 1,000.
Okay, so, but let's be clear. You are not saying put 100% of your money in gold. I mean, there is an allocation. We've always talked about the triangle, right? Mm-hmm. And preservation, growth, and then on the right side of the triangle, cash. And so what is the strategy right now as gold rises, yet we think it's going to rise more?
Yeah, I mean, we got to watch 2 great games on Sunday. Well, one was reasonably great, and the other one was absolutely pathetic. Sorry, I am
in the snow.
I'm a recovering Broncos fan, particularly after the game. But you can see the importance of defense. And when we look at the perspective triangle, we categorize gold and silver not as a high growth asset, even though it was one of the best performing assets, and silver last year. It's an insurance play. And the fact that it's moving, the fact that it's performing the way it is, it's the signal that matters. What is going on? The barometer is telling you the storm is here. Mm-hmm. And people are saying, no, I'm fine. So let me digress for a moment to strategy.
Okay.
I think for early adopters to the precious metals market, you have the luxury of taking gains. There's a justification for someone that started with a healthy percentage allocations to precious metals to now take some money off the table, as that percentage of your portfolio has swelled to very high allocations.
Right.
So you started with a third, which is what we recommend in that perspective triangle.
Right.
And it may be 50, 60, 70, it may be 80% of your assets today. Mm-hmm. Is it reasonable to trim that back? I think so. If you have followed our advice and structured a portfolio with a broad array of metals, you also have the option, not necessarily of trimming it back, but of swapping from one to the other. In this case, from silver to gold.